I think it's interesting and how, I took about a 45-day, maybe almost a 60-day hiatus from the news because I felt like it was just a lot of propaganda from 60 days on in. He said, she said. And I kind of made my decision. And for the first time, I didn't really feel that anxious about the election. I was anxious about who was going to win, but it wasn't stopping me from doing anything that I hadn't already planned on. And I think you made a good point. Is historically, it has made no difference if you're thinking about buying a home. It has made no difference historically on mortgage rates.
Well, exactly right. Plus the fact that the election as an event, regardless of the outcome that you wanted and that doesn't in fact happen, even to the extent it's going to affect something like a mortgage rate, it's not an instantaneous phenomenon. It takes time. I mean, we now are going to have, a new president, somebody who's back again after being gone for 4 years. What's going to happen with mortgage rates is going to have more to do with, like I said earlier, the policy implications of the change in the administration. What is the new incoming administration going to do with fiscal policy, with tax policy, with tariffs? And to what extent will that have an impact on the financial markets, in particular the bond market? Because again, I keep saying the bond market is what you want to watch to see where mortgage rates are going. So those policy implications will play out, but it's going to take time. It's not going to be like, okay, we have a winner, and now and within a month, rates are going to go from here to here because of who the winner was. It's not that. It doesn't work that way. It's got to play out. Of course, policy takes a long time to, consider and get it passed and get it implemented. So this is going to be a longer haul phenomenon, and it's going to take a lot longer to see where rates go because of this event.
Well, so what do you think, now again, not a crystal ball, but just data, what should prospective buyers, what should they do now?
Well, I think, and I'm going to say, by the way, in a minute here, not just buyers, but homeowners as well, if you're contemplating a refi or trying to get cash out of your home. But if you're a home buyer right now, if nothing else, I would hope that you have come to the realization that, as we have said on this program in past episodes, in terms of higher mortgage rates, they're going to be higher for longer. There is not this dramatic drop in interest rates around the corner to where we're going to go suddenly from low to mid sixes to low to mid fives, or gosh, it'd be great if we got into the fours. That's not around the corner. In fact, some of the major market players like Fannie Mae have sort of reassessed their interest rate forecast for the coming year, and it's not in particular anything real aggressive. We're probably going to be sticking around this 6% plus or minus level for an extended period of time. So if you're a prospective home buyer, I think what you've got to do is, number one, embrace the fact that we're going to probably be at these levels for a while. One of the things the Fed did announce today at the conclusion of their meeting is noticing that inflation continues to be rather stubborn. Well, that kind of language, when you kind of peel the onion and interpret what that means, is what they're kind of signaling is, to the extent we're going to have more reductions in the Fed funds rate, it's going to be slower and it's going to be more modest. So we should not expect that suddenly in 2025 we're going to go from the current level of the Fed funds rate at 4.5 to 4.75, and suddenly it's going to be dropped to 3. That's probably not going to be the case. So if you're a if you're a home buyer or a prospective home buyer, I think now is the time to realize we are where we are, and we should, if we need or want to buy a home, we should really consider going ahead and pursuing that. First of all, find out, with somebody like us, we can help you determine if you can qualify at today's mortgage rates. And then understand that if we can determine that, we can provide you the financial tools to go out there, find the home, and make an offer and improve the financial impact of getting that mortgage. And of course, what I like to talk about in that regard are temporary interest rate buydowns. I call them buydowns are the bomb for a reason. They are a way for you to take advantage of the current housing market environment. Rates are where they are. They're going to probably be at these levels for a while. There is more inventory on the market. We are seeing a little bit more movement in list price to actual closing price, where closing prices are now starting to more commonly be at 97, 98, 96% of the original list price. So it's shifting slowly, both in terms of inventory, but also buyers having more leverage. And so with this environment, we can show you how using a temporary buy down is a great way to take advantage of a home ownership. Because again, as I've mentioned at last week's program, and frankly, I have been for several weeks now, several months now, home prices do continue to go up. Now they're moderating. The rate of increase in home prices is moderating, but they're still going up. They're not just dropping. So given that's the case, the temporary buy down scenario is a great program to use to take advantage while you can now get into home ownership and then be able to benefit from that appreciation after you're able to close on that purchase.